This is a part 3 of a 4-part video series that I'm doing on moving averages. This is a back to basics series. It's going to be a playlist on YouTube so you guys can see the whole thing. First, I started with the 200-day moving average. Then I talked about the 50-day moving average, and both of those were regular moving average. What we're looking at now is not a regular moving average. What we're looking at now is called an exponential moving average. So why did we switch to the 20-day exponential moving average when we switched to the 20-day line? And why were we using standard moving averages when we were using the 50-day and the 200-day moving line? The reason for that is the 20-day moving average is very reactive. We're only looking at 20 days before the price is created as the average. So it's very reactive. And while the 200-day and the 50-day moving average are created to give us a gauge for market health or market sentiment and for entries and exits when you're moving with the trend, the exponential is slightly different. The exponential moving average we use for pullbacks. Let me just erase this and I'll explain to you why and how. All right. So when you're looking at the 20-day moving average and price is trading above the 20-day EMA, that's what it's called, exponential moving average. When it's trading above the 20-day EMA, it means price is trending strongly. That means there's already a strong trend in the market, okay? So you're kind of late to the party if you're looking to get in when the stock is trading strongly above the 20-day moving average, okay? So that's usually not what you want to do. The best way to utilize the 20-day moving average is for wait for price to move above it, like right here, and then move below. And those are considered very low risk entry opportunities. When the price is slightly below or touching the 20-day moving average, you're waiting for a pullback. You're waiting for a pullback to the 20-day line and then for price to move back higher. So this is a way to trade pullbacks. You wait for price to, let me just do the whole thing over again so it makes more sense. This way it won't confuse you. We're waiting for price to rally above the 20-day, all right? And then we're waiting for it to pull back and then trade higher. And that's our entry zone. The nexus between this line and this line, the long-term and the short-term trend, is a low-risk entry opportunity. So what you would do is, this is actually a really good example here. That's the long, that's the price, the trend moving higher, then coming back here, and you enter right here and then ride this all the way up and then wait for it to come back up and buy here and then ride it all the way back up here. So you're waiting for price to strongly trade above the 20-day exponential moving average, and then you're waiting for price to pull back below the 20-day moving average. And you could do that, and the best time and the only time you want to do that is when markets are trending strongly or when stocks are trending strongly. Do not trade 20-day pullbacks when markets are stagnant and are not trending. So first you need to figure out if the stock is trending, and then you can use the 20-day line for pullbacks. All right? I hope that helps. And again, 200-day moving average for the overall health of the stock market, 50-day moving average to see where the stock market is or where the stock is, to see whether it's overbought or oversold, and 20-day exponential moving average for pullbacks. All right? Hope that helps.